Hi, good morning. This is Leah. We missed you guys, and obviously, this is Hyperwave. We have Tyler here. I'm going to be as hopefully quiet as possible. I'll have myself on mute, but I can walk first day, so that means I can also drive. Second day, I probably shouldn't have yesterday. And this is going to be a really, really interesting one. And yes, I think we have surprise guest Tone coming on in a little bit. But very, very interesting is all I'll tell you. And it's my favorite coffee shop, but I found like a little corner. So anyways, I will give it straight over to Ty. Ty.
Great. Thank you very much, Leah. And hopefully Tone is going to be able to join us. This is a very, very important vlog for us. I have no idea how long it's going to take, but I just wanted to take some time to give people some perspective on my views of world markets. We're not going to analyze world markets. I'm going to give you a quick tour. But in the 40 years that I've been in this business, we've gone through a number of incredible markets, both very, very good and very, very bad. But I'm here today to say that I have never once seen the opportunities developing as quickly as they are worldwide in the marketplace. And unfortunately, I think very few people are prepared for what could happen and inevitably is about to happen, both very, very good and very, very bad. We're going to take a look today at some major markets around the world, not in terms of trying to figure out what they're doing, but in terms of showing you the tremendous diversity that's beginning to develop through regions around the world. And the meaning of this is there are going to be places you have to avoid or short, and places you want to be in and own. And that includes the United States, but it also includes Asia and parts of Asia, and Europe and parts of Europe, and developing and developed countries around the world, because we are on the brink of some tremendous moves in these markets. One of the things we've all followed is the crypto market and the Bitcoin market, which is just one tiny example of what I'm talking about. So to prepare people, particularly on this channel, we're going to be talking about hyperwaves that our research group has been identifying. And literally, we have 27 people now, a dozen of which are working every single day, and some of them 24 hours a day, purely volunteers, finding hyperwaves throughout world markets. And I'm not ready to tell you how many they have found, but the number is enormous. And to me, it's rather alarming, because they're in different stages of either going up or going down. Many of them are still going up in phase 3s and 4s, including in the United States. But some of them have already turned the corner and have started down the other side. So today we're going to look at some charts, but more importantly, we're going to just talk conceptually. And I'm very happy to see that Tone has been able to join us. Tone, say hello to the folks.
Hey guys, yeah, I actually woke up, so this was great. Jumped right on the stream.
Great. Thank you very much, Tone. What we started by saying is I'm calling this the greatest opportunities I have ever seen in the financial markets in my 40 years, because the movements are coming in very powerful forms, and depending on where you are looking, you want to either be out of markets or in markets. And I'm talking about regions of the world like Southern Europe, as opposed to Europe itself, and places like Eastern Europe, and places like Asia and Africa and South America compared to the United States. And all of a sudden, we find ourselves in the possibility of trade wars that could influence greatly all of these regions. And within each region, people that live there need to understand what risk or what opportunity they have. Bitcoin is one tremendous opportunity. Right now, though, it's on the downswing of a hyperwave. We've identified over 50 brand new hyperwaves around the world, in Europe, in Australia, in the United States, in China, in Korea. And over time, we're going to be bringing those to everybody's attention. We're not going to go into the detail today, but one of the ways to prepare for this is to have accounts open up that allow you to short, allow you to buy foreign securities, allow you to buy ETFs in the United States that are specific to individual regions or countries, and also to begin getting into options and option trading, because being able to buy puts and calls to either hedge or to speculate with, even though it is very advanced relative to most of the people that have come to us through the crypto ecosystem, many of whom know trading cryptos but have never been exposed to these markets. And my position today is that even though there's tremendous opportunity in cryptos, either shorting anything but Bitcoin and eventually getting into Bitcoin in a big way is a huge opportunity. But focusing only on that small area is missing the big picture. And the big picture is that in the United States, we've got markets in the third and fourth phases of a hyperwave that both Tone and I have been saying went through a period of about 6 months in which there was a question about where they wanted to go. And those questions have now been resolved in my mind, and I know in Tone's, to the answer that they want to and are going up. And that's important because a great number of our listeners are US citizens. They have retirement accounts, and those retirement accounts should be aggressively in the US markets, in the stock markets, because for the next year, maybe 2 years, the returns could be enormous. So I'm just laying the groundwork for what we want to talk about today, which is not just Bitcoin and cryptos. It's my observation that even though the 1990s had 5 of the best years in US stock market history, 1995 to 2000, and even though the period from 2000 to 2009 were the worst 10 years in stock market history, not compared to the Great Depression, which was two very large down moves in the market from 1929 to 1933, and again in 1936 through 1937. But because we brought in many other factors in the period from 2000 to 2009, including almost losing control over the world financial situation. We did that into the 1930s. We did it again in the period from 2000 to 2009. I don't believe that what we saw in the period in 1930s or in the period in 2000 can compare with what we are about to see, both on the upside and the downside of various asset classes. And because of that, Leah and I will do a whole vlog on option trading, the basics. And then we are going to do another vlog on shorting stocks, buying inverse funds, and hedging positions, both from a tax point of view, but also from a tactical and strategic point of view. So that's the theme for today. And I'd like to get Tone's view on my statement that we are in the midst of and on the verge of some tremendous opportunities, as well as some tremendous perils on in the financial markets worldwide. Tone, sorry to throw all of that at you so early in the morning, but I'd love to hear your point of view on that.
Yeah, that's I didn't expect. I didn't know what the topic was for today. So I have to say that I do agree that the U.S. stock market is, I'm bullish the U.S. stock market. I unfortunately, because of being so busy in the world of Bitcoin and crypto, I haven't really had a chance to evaluate, and just step back and think about the worlds. And I'm not sure I have the same, gloom and doom view on the rest of the world's markets. I either A, I haven't thought about it, or B, I haven't really looked at it because I've kind of stepped away from the economics. This is why I don't do as many real market videos anymore of traditional markets. I will also, I just want to do a very quick screen share when you were talking about the current period being the worst period since the Great Depression. This is what the long term looks like in the stock market, and what we dealt with basically between this area here, between 1999 and until we broke out in 2015. That was a good 15, 16-year period of the stock market doing absolutely nothing while having two crashes in it. This is not uncommon. The stock market did nothing for a slightly longer period of time between the early 60s and the early 80s, was a slightly longer period of the stock market doing nothing. And the same thing, it had a couple of crashes, the most notable one being in 1974. And you see the pattern perfectly repeat in the early 2000s, as it did in the mid 60s into the early 80s. And a similar pattern also took place after the Great Depression. And I think the Great Depression is an outlier in both directions. I think the Great Depression is an outlier with the raging 20s going into the peak. It went up, way more than in any time in, in modern history. And then it crashed way more than in any time in modern history. So I really think the Great Depression is an outlier. If you remove the outliers both above and below the trend channel, you do end up with a boom cycle of 20 years followed by stagnation for approximately 15 years. So those were my findings when I did a presentation on the history of the stock market a few years ago. I've only done this presentation one time in my life, and it's hard for me to redo this chart because TradingView, where I made it, has removed the back-end history of the first 30 years of this, and it makes it hard for me to remake this graph. But other than that, I thought it took me 3 days to put this together, and I thought it was really, really great. And right now we are significantly higher because it's been a couple of years since I put this together. And here's the 1987 crash. It looks like absolutely nothing.
Great. Could you keep that chart up just for a little bit? If you could point back to around 1975.
Yeah, right here, we're coming off this dip. You want me to zoom in on that?
No, that's okay. But the reason I'm doing that is the year that I started in these markets.
That's great. That's almost like starting in 2009.
That's exactly right. I became a broker in 1975 after spending 4 years in the Coast Guard, and you see what I was faced with from 1975 to 1982. My first 7 years, the market wasn't going anywhere as measured by the Dow Jones Industrial. Now, the S&P went up a little bit. This is where Fidelity and Peter Lynch with the Magellan Fund got started and started making a lot of money by buying things other than the big Dow Jones stocks. He was buying small and mid-cap companies, and the Magellan Fund took off and made him world famous and one of the greatest investors during that period. But notice what happened where Tone's pointer is. As we broke out above 1,000, which we had not been able to break out of since 1965, we finally broke out and stayed at 1982, 17 years later. But then my career was punctuated by nothing more than markets going straight up, except in 1987, that drop that Tone pointed to, where we dropped 22% in one day, but we closed that year up 7% for 1987. So even though we looked like the world was coming to an end, it was only beginning a tremendous move back up. And ever since then, from 1988 until the year 2000, the market kept going up and kept going up and kept going up until we hit the year 2000. Now, one reason I talk about hyperwaves is
Tyler, I did. Sorry to interrupt. I did a bunch of research when I was putting this presentation together. I looked back and I looked at the old articles that came out that day. It was, this was a funny presentation. I mean, look at this. Does 1987 equal 1929? They were comparing, to 1929.
Yeah, it was an amazing period. And it was also the period that the Federal Reserve and the U.S. Treasury and major brokerage firms found a way to reinflate not only the stock market, but keep the economy growing. And they've used those techniques over and over again in greater and greater degrees, starting in 2000 under Greenspan, and then Bernanke, and then Yellen, and now Powell says he's going to do the same thing. So one of the reasons I came to the conclusion that we're on the verge of massive opportunity, and I don't mean it to be gloom and doom. What I mean is we are seeing central banks, not just the Federal Reserve, but central banks around the world attempting to maneuver into situations that are causing tremendous bubbles in some places and breaking in others. And that's what I mean by opportunity. You need to understand the macro picture of where we sit right today in July of 2018. And we're going to look at some markets to get an overall view of why this is so important.
Hey, Tyler, I got one question for you as I was putting these articles together because I wasn't around back then. I mean, I was alive by 87, but wasn't really around. Do you remember? I only know two Bernies, Bernie Sanders and Bernie Madoff. I would love to know which Bernie they're talking about getting 6 months, because for some reason the name Bernie seems to be obvious at that time.
That's very funny. Yeah, he got it, and I can't even remember who it was on a gun charge, believe it or not.
No, but which Bernie?
Neither of them.
Okay, was there another Bernie that was so popular that he's recognized by his first name? I've been wondering about this for years since I found the article.
That is
like, this is a front cover of the Daily News or something.
I love it. That's great. I'll tell you what happened though that day.
No, but do you know who it is? Which Bernie are they?
I don't. But we can find that out easy enough. That everybody's name was in the news, starting with a bunch of the people that were in the junk bond market, like Milken, who is still on the scene today, that led up to the problems developing very quickly in the junk bond market and with credit spreads, much of which had to do with the crash in 87, because there was a thing called portfolio insurance that was supposedly going to save us from any sort of a downturn in the market, and it did just the opposite. And it was all based on credit, not too different than what we saw with long-term capital in 1998, where they became so leveraged that a tiny move blew $1 billion up overnight. That's what happened in 1987. Now, there was a hyperwave in the Dow going into the crash of 87 that allowed my clients to get out on the Friday before the Friday where the sell-off started. So 1 week earlier than the October 19th crash on Monday.
And were you doing this hyperwave on the Dow or on the S&P? Well, I mean, probably both, but you were doing it on the Dow.
On the Dow.
Okay.
And we had a Friday close below a fourth phase line, and that got us out. And it was very embarrassing to tell clients that we wanted them completely out of the market. At the time, we didn't have that many clients. And luckily, almost all of them did it. The ones that we had discretion over, we took them out. And on that next week, on that Monday morning, I was literally standing on the top of my desk, waving my hands because Hyperwave had worked so perfectly. We'll go back and we'll take a look at that time, but it occurred again with the NASDAQ going up to the year 2000. And it is occurring again today, but where it was localized in the NASDAQ because of the dot-coms and localized in 1987, it was not localized back in 1929. It was generally true. There were markets all over the world that were in hyperwaves, not just the Dow. And that's what we see today. I didn't realize it until our Hyperwave research group began sending us all of these examples of individual hyperwaves in companies around the world. I was assuming that it was basically US based because the technology stocks and the FANG stocks, and it turns out that is not true. I've just given a number of our clients in Australia 8 different hyperwaves with individual companies in the Australian market. Australian market is hitting new highs, which seems strange to me because they are commodity-based country and they do most of their trading with China. And China is approaching it's in a bear market in their stock market. And with everything going on trade, you would think it would be having a very negative effect on the Australian market. But as I said, we've found a number of individual companies that are in phase 3s and phase 4s and accelerating to the upside. So that just gives everybody kind of a layout. And Tone's chart is a fabulous one. I'd like to get a copy of your annotations because that looks brilliant. That's the starting point for macro analysis. Yeah, please.
So good news. The good news is I just opened TradingView and my data is back.
Oh, perfect. That's great.
So it's all there. I have it all on TradingView. The other news is I wanted to take a look at the Dow Jones with the sequential during the period of the 1987 crash.
Wow.
And there was a 913. This is the weekly chart. There was a 913 in the week in July, a bunch of 13s then after, and literally a sequential 13 the week of the fall. But that's the weekly chart. There was a lot of 9s because there was a lot of bull market. I also want to jump to the daily chart in the same vicinity. Where am I here? Oh, I'm back to 17. Okay, I just want to take a look at it real quick. So I need...
no, I'd love to see it. I'd love to see it. Everybody's got to remember that there was no sequential back then. It didn't come along until the end of the 1970s.
No, but this is 1987, so it was definitely around.
Yeah.
It was a night. Yeah, because Larry Williams and Tom DeMark.
1979. You're right. That's when it came out.
Wow. Okay, I'm having problems with the dates. 1987.
October the 19th is the crash.
Yeah, and I just want to get it into that vicinity.
Yeah. There we go.
So there you go. So there was a daily 9, literally right there, at the peak. There was a 9 right there, and this was October 6th right here, and that led us into the crash day, which was itself on a 9 buy, but on a very ugly candle. And this is why, so there was a 9 sell, but unfortunately there was also a 9 buy the day before, and it gapped down and got destroyed that day. This is the Dow. Curious what the S&P would look like.
Exactly. But, we had a weekend between the two. On the Friday prior to the crash on Monday, which was the 19th, the 16th was a big down day. And a week before that, which would have been the 9th, which was a Friday, is when we got our sell signal on a weekly basis on the Hyperwave.
Yeah, now you remember what day was the 1929 crash?
September the 22nd, I believe.
So this is the daily chart.
Wow, are you kidding me? I had no idea that
this is the daily chart on a Dow during the Great Depression.
And the peak should have been around 388.
The peak was right here, and the high was 386.
386. What about the day before that?
Well, 384 was the high.
384, 386. Okay, 384.
Yeah, so this was, I think I should look at it on a weekly scale. I think it would make so much more sense. And then we'll move on. I will also say that while I would love to listen to your discussion on options, I probably will not participate in your options discussion. The reason is because I don't want to accidentally say something that's going to get me in trouble, because I trade options and somewhat profitably along with another person, and we have some strategies that nobody else knows about. So it's best to keep my mouth shut whenever I talk about options.
Great.
Or it's best not to, for me personally, not to talk about options in order for my strategies to continue to work. It was October, right?
Yes.
Yeah, the date doesn't really matter. Nothing. Damn, that sucks. Did catch the low though. Didn't give you the warning on the high on the sequential, but the low got called perfectly.
Wow, that's amazing.
I'm surprised. It was just this one candle. It was wait. How come? Oh yeah, these are weekly. That's right. It was just this one candle that broke my count. That's unfortunate. Let me just pull back. Let me just grab these.
This is important, everyone, because it shows that technical analysis does not change with time, and it does not change with asset class, and therefore it does not change with crypto or Bitcoin. To argue that yeah, please.
Can you also, and I'm going to go quickly because it's getting loud with Dylan in the background here. Can you also explain, since we started this off about shorting options and then your background with investment, again, as you start to explain the TD system here and how it hasn't changed over time, can you also explain from that perspective how all of those three things come into play and how you can utilize this through historicity in the understanding of it?
Well, we will do that, but that will take a long time. You and I, and hopefully Tone would be able to join us, just conceptually talking about the advent of options. And you've always been able to short, but options and ETFs and short ETFs and inverse ETFs, none of those were available in these prior years. In the 1970s, there were options, and people were trying to understand options. That's when they became famous and the CBOE got started. But we've got tools today, but you need to understand how they work. And you can't do it at a basic level. You can understand basically what the terminology means, and you can experiment on certain sites and try various things, but you don't have to get very complicated here. And we will go into that in a lot of detail. But it's important that these tools are available today and they weren't before. And they're very, very liquid, and they're very well understood. And the technology behind them allows you to do very deep analysis or very cursory analysis, and still it can be very effective. Now,
I just want to add real quick that options are amazing. Shorting options may be the most dangerous thing to do in the history of anything finance and money.
Absolutely.
Please Google long-term capital management.
Exactly. The only thing worse is the commodity market, and that's only because of the unbelievable leverage that you can get.
Well, again, shorting options on commodity futures is the most dangerous thing you can do in the history of money.
Absolutely. And the flip side of that is, because of that, a lot of people are afraid of options because they've heard the horror stories. And you need not be afraid of using the basic tools of puts and calls, particularly from a hedging point of view. It's very simple, very powerful, very inexpensive, and it can be done immediately. But we will go into that in some detail. So what I would like to do now is just give you a very quick sketch of why I made that comment and why this theme today is we are in the midst of the greatest opportunities I have seen as a professional investor in 40 years. And I would have said that back in the 1920s if I had understood all the things that we're talking about today. Back then, you could not do all of the things we can do today easily, electronically, without going to a broker, without going through an exchange in which orders are known by people keeping the books of who the buyers and the sellers are. And it's all done electronically. It's all done very quickly. You can put hedges on, take them off. This is an incredible time to be in finance and financial markets. If I thought that we were going to go through a period of 10 years of flat markets worldwide because there weren't tremendous forces upwards and downwards being exerted on the markets, I wouldn't be doing this vlog today. But that is not the case. I think we got the possibility of seeing 100,000 on the Dow, which on Tone's chart is the upper end of that channel that he drew. And we will see that in our lifetime. And I'm 69 years old now, and I believe I'm going to see it in my lifetime. And that means...
Yeah, Tyler, here's the update. Since TradingView updated me historically,
Great.
This is where we are. We came very close to hitting the top of that channel. Yep. And my target, I made this chart years ago. I made this like maybe very early 2016, I think.
Right.
And that was my ultimate target, like somewhere in this area, like maybe not 100, but 80 definitely.
Well, take a look at the chart from 74 until the peak in 2000.
Right, we went but we went from the bottom of the channel in 74, which was at like $600, all the way to 11,000. That was a monster bull run. This time we didn't fall as low, so we could overshoot the channel. That's why I do have this arrow saying, hey, 10x from the last big peak of 1,000. From the last big peak of 10,000 where we got stuck. 10x does take us to 100,000. It's a very reasonable target. But the thing that I found most interesting is that between the low in 1929 until the basically 1993, we stayed in the bottom half of the channel. That's from the 1930 32 all the way to 92. So that's 60 years we spent in the bottom half of the channel. And now, since 1993 until now, which is what, 24 years, we've now spent in the upper half of the channel. So if we spend the same amount of time in the upper half of the channel, that means we should not fall below the midpoint for 60 years since 1993 till 2050.
Well, and the other part of this story that's very important to note is I'm not saying that what I said about 100,000 is going to happen. I got very nervous, as you all know, in the last 6 months because we were in phase fours of some very important markets. And we are still in phase fours in very important markets, according to Hyperwave. Now, Hyperwaves have a very funny peculiarity, and that is that when the phase four is over, bad things happen for a very long period of time. So I need Hyperwave analysis. to be really neutral about long-term projections. So even though there's the possibility of wonderfully great things happening in the US market, we came very close in the last 6 months to reversing that opinion. Now it looks like it's reestablishing itself.
Yeah, and Tyler, and I was not as nervous as you. And one of the main reasons is because 2 to 3 years ago, I did so much research on the technical analysis of the history of the stock market. And this chart has me bullish the stock market until 2030. So I was not as bullish mainly because of this. I was not as bearish, I mean. Because of the long-term consideration that yes, there might be a 1987, but it will be short-lived. Like, and I will only get nervous if we start breaking the top of this channel, which at the time of, a month ago when we hit the high would have been 33,000. If we were at 33,000 a month ago, I would have then been nervous that a major correction down to the middle of that channel is very possible. So I would basically be looking for the market to hit the top of that channel. And let's say in 1920 or 1922, the top of that channel is at about 41,000 points. After that, I can potentially see a 40% crash down to 21,000 on the Dow. But the only thing that will make me nervous in the stock market is if we're touching the top of this channel.
Well, and I would agree with that. And I think it's possible that we could touch the top of that channel maybe before those dates, because the fourth phase of hyperwaves is almost vertical. So yes. I could see the possibility of in the next year or two touching the top of that channel, which would be perfect.
I completely agree. Like right here in 1984, the stock market broke out above 1,200. It then went from 1,200 up to 2,600 in 5 years, right?
Exactly.
That was a huge move from 1,200 to 2,600. It's actually not that big. It's above 50% in 3 years, right?
Yeah. And so, look at 1995 to 2000. We go from the middle of the range.
Right. It was 4 to 12. Yeah. It was from 4 to 12. We went up 3 times in 5 years. So if I see a bull run, and I think we're on it, when we broke out above 18,000, we have started to go exponential, but I would need to see us at least double that. So 18,000 times 2 is about 36,000. 36,000 on the top of my channel comes in September of 2019. Exactly. And I think that is very possible. Also, it being September is very ironic because that's when markets tend to crash. People get that confused. Markets tend to crash in September and bottom in October. So sometimes the markets crash in October, but they tend to bottom in October. So in September, October of next year, if the Dow Jones is pushing, mid 30,000 range, I will become very, very nervous that a crash down to the middle line, which by the year 2020 is at around 16,000, is very likely. And I would love to see a back test of the prior highs, which were, though the 1987 crash didn't really get you to the prior highs, it stayed above that. So maybe a crash all the way to the middle line, maybe too much. But a 1987 style crash, hopefully not in one day, hopefully in maybe a few months, would be very reasonable. But if we do get to 36,000 by this time next year, I would certainly be looking for a nice 40% stock market correction, and then we go back up.
So, folks, what you're hearing is the combination of two quote unquote experts in terms of market movement, looking at different things. One was a sequential system, one is simple charting, but done with a lot of expertise. And one is using a tool called Hyperwave, that all are saying the same thing, which is we are in the middle of, even though we've had 10 years going on, 10 years of a bull market, one of the longest in history, we are at the beginning of a period that is offering huge opportunities, as opposed to the period from 2000 to the period to 2009, as opposed to the period from 1965 to 1982, and as opposed to the period from 1928 to 1953, all of which were periods in which you had to be very nimble because markets were going up and down and up and down and up and down and not making any progress. What you're looking at now worldwide are all sorts of markets, not just stock markets, but commodity markets, real estate markets, the major asset classes giving you enormous opportunities. I would caution against buying and holding strategies because of all the cross currents that we're talking about. What you need to do is you need to understand what the trend of a market is and have tools that help you understand when that trend is beginning to change. You know 3 of them already by listening to Tone and myself and others that have tools that tell you when trends are beginning to change. But first of all, you need markets that are trending in a massive way. And I get back to my first statement, I have never seen markets with more opportunity than as we sit here today. So with that long overview and great help from Tone, I'm going to do a quick screen share.
Thanks, Tyler. I will just add one quick thing.
Yeah,
all
please.
You have to do is remove one day from 1987, just one day. If you remove that 23% down day, you had an 18-year straight up market that went 10x.
That's right, and accelerated in its last 5 years. And I think that's where we might be right now with the market after 6 months of consolidation breaking out to new highs. We might be on the verge of that acceleration. Now, yeah, please.
So we did get a question, sorry guys, from the live chat that I think is one good one before we transition. And that is, what impact do you think Bitcoin could have on your projections moving forward? And I'm going to add to it, especially if we gain more mainstream adoption. And you can also answer if store value or medium of exchange. But that's the question.
Exactly. Tone and I differ a little bit on this, but I think what happened either on purpose or by accident at the end of 07, 08, 09 was the opportunity to have a new asset class that can, in some sense, change the course of financial history. Because without that option, we're back to either a gold standard or more printing of fiat money. And what's causing all these hyperwaves, what's causing this tremendous dislocation around the world, what's causing these trade barriers and tariffs and the talk about it, is the globalization of finance. And that's the underlying force coupled with the globalization of technology and communication, which allows people to communicate instantly across borders. So we find ourselves on the eve of the potential of a macro meltdown because of credit and debt. And for 10 years, we've been given an option that 10 years later is still uncertain. It's being debated in front of Congress and in front of governments around the world. It's being debated within the ecosystem itself in terms of what is valid and what is not valid. And because of that, it itself, meaning Bitcoin and cryptos, is a question mark. It's not an exclamation point. I believe Bitcoin is going to become an exclamation point in world finance in the years to come. And to the extent that it is, it will change all the projections that Tone and I just talked about traditional markets, because it will affect world finance, which is my second point about why the opportunities are so huge right now and unprecedented, because we have a new player on the scene.
Perfect. And before we move on, just a quick response, Tone. What are your thoughts and what's your response?
I'm going to try and make it quick. This needs to be its own show. A lot more thinking needs to be done. But here's how I've seen. As you all know, I think the ICOs are one of the worst things I've seen in my lifetime. Now, but having said that, look at what happened from 1994 all the way into 2000 when the stock market tripled. Why did it triple? Sure, there was an internet, and the internet brought us this amazing innovation. Now we have Bitcoin, and Bitcoin brought us this amazing innovation. But the reason why we had a bubble is because all of this fictional value was created in the financial markets because of .coms going public on the stock market, not even having anyone other than a web developer, and these stocks were trading at $100 a share. People believed there was value behind them, but it wasn't. It was all fictional. But just because it was fictional doesn't mean that people didn't believe in it, and that's what drove the stock market up. I foresee this already has started happening in the ICO space, when a lot of these people are making money out of thin air, and all of these ICOs are being valued at billions of dollars of money that is basically, there is nothing under that value, and it's going to disappear. But until it disappears, there are some people cashing a fraction of that value out, and a lot of it is going towards the economy and towards buying traditional stocks. So I don't know how big this ICO bubble is going to grow, but if there is money being created, because even if it's like, a tulip style Ponzi scheme bubble, even if it's being created in one side of the economy, it doesn't mean that it can't trickle into other parts of the economy, raising the value of the stock market. So if I know this is a little it's on a very small scale right now, but if this ICO fictional, useless Ponzi's aren't I know this sounds like I'm a government shill for regulation, but if the SEC does not, put an end to the ICOs, and this is how every single company will now, create value out of thin air, I can certainly see that leading to the boom in the stock market, bringing it to $36,000 next year. There could be massive ramifications. Now, when this bubble goes belly up, Bitcoin will be left standing, just like the internet was left standing with a handful of companies. But
yeah, brilliant. Very important point, folks. And what I mean by that, Tone has told us that in a number of different ways. But this is the first time where what we're trying to do is get a much broader macro picture and tie Bitcoin and crypto into it. Those of you who have believed from the beginning that you simply want to buy and hold Bitcoin, that's fine. Those of you who thought you wanted to play in the crypto market, that's fine. That's up to you to do. What I'm trying to say is this new alternative, 10 years old, but still a new asset class, is going to tell us a lot about what the next 25 years will look like on a macro basis. And we get evidence from that by looking at all the markets, not just the crypto market. And the crypto market, to me, including Bitcoin, is still a question mark. The crypto market by itself without Bitcoin is not a question mark. It's an exclamation point because it's going to go to zero for all the reasons that have been discussed, but not Bitcoin. Bitcoin is on its way down. It is going lower. At the end of this show, we will take a very quick look at this last spike that we've seen up to 8,300. And my conclusions are the same. I know Tone's are also. And we might be right, we might be wrong. In either case, it is irrelevant to the bigger question, which is, if it is going up from here, meaning Bitcoin, that unfortunately will probably mean it will carry with it a lot of these other cryptos, and it will just make the problem worse later. If we can wash them all out, which is what I believe we are doing now, then the last one standing will be Bitcoin, and then Bitcoin will be able to do its thing relative to all these other markets over the next 20 years. And with that, I am going to flip over and just look at a couple of charts very quickly, which, as you know, I have been doing on a random basis. The first one I'm going to look at is the Netherlands. This is a 5-year stock chart of the Netherlands, and it looks even better than the US, different, but this correction over on the right of the chart.
I love the cup and handle. I love the cup and handle.
And it's a fabulous one, isn't it? It's incredible. Yeah. This is a market that wants to go much, much higher. And it's a big shipping market, and it's a much bigger market in terms of trade and economic activity than the size of the country would dictate. So that was a very interesting chart to me. I'm going to take a look at Hong Kong. Hong Kong is acting similar, as you would expect, to Shanghai and the Chinese market, which was looking awfully good at the beginning of 2018. This is a 5-year chart also. At the beginning of this year, we were up to 33,500. We are now at 28,000. And you can see what Consensio is saying. The long-term moving average is now rolled over, and you are in a bear market as you are in China. So you've got the Netherlands and Northern Europe telling you one story. You've got the US telling you another story. And now we will take a look at Switzerland. Switzerland is kind of caught in between Southern Europe economics.
Wow, that looks, I'm sorry, Tyler, that looks so much like Hong Kong, only like 3 days later.
That's exactly right. A lot of problems over here, a lot of problems down here. When you look at Hong Kong, what you see is same problems back here, but not the same type of wild movement up and down as you're seeing in the Swiss market. Now, what's happening is the euro. What's happening is problems in Germany. What's happening is problems in Southern Europe. Italy started this mess with its bond market, but Portugal, Spain, and others, Greece, are in similar mode. Part of this problem is Brexit, because that's the beginning of a crack in the European Union. And the threat is that Southern Europe could be doing the same thing, that Italy might find the only way out of its problems is to get out of the European Union. In any case, these tremendous forces are regional, are not affecting the United States, and have little or nothing to do with what we're seeing in China and Asia. So that's an important perspective. Now we will take a look at another European country, Austria, that looks very different than what we just saw in Switzerland, although the end result is the same. We've got the long-term moving average rolling over. We are in a bear market in terms of consensio, but look at all of this activity down here where parts of Germany and Northern Europe began to question what was going on, partially because of Brexit. Let's take a look at Portugal down in the southern part of Europe, and it doesn't look like we're looking at the same continent. Here, you've had a massive sell-off from 7,800 4.5 years ago to 5,600 today, but got as low as 4,400. And this has to do with banking, debt, and credit. It goes along with what you saw in Italy, what you're seeing in Spain. And because they're part of the European Union, it causes tremendous friction with the northern part of Europe and Germany specifically. But this market looks like it's living in its own world and is slowly getting back up to some strength, although it's still got lower highs than these two previous ones, and it's anybody's guess where this is going to end up.
Yeah. Hey, Tyler.
Yeah.
If you stay on that chart for a second. Now, I understand that we are still lower than the 2015 high, but at which point, on which candle, would you start to consider this to finally get out of the bear market?
I think just breaking above these highs, you're going to see a big spike in price. This is one of your triangles, I believe, and I think it's a very powerful one.
Now, these are weekly candles, so I would have actually been optimistic about this asset around the last week of March 2017. Basically, when we broke above 4,800.
Right.
Nope, lower than that.
Right there.
Right there. That big white candle.
Okay.
That one. Because if you look back, the low comes in June of 2016. We then make a lower high, but then we clearly make a higher low in November. And then I would patiently wait. The moving averages had, consolidated. And when we broke out above 4,800, with both moving averages going up, one above the other, and breaking above prior high, breaking above a yearly high, I would become bullish above 4,800. In March, right before, right in the middle of that big up week in March of 2017.
It'd be interesting for you while I'm doing this is to pull up the Portugal chart and take a look at what Sequential said down there at that bottom, because that's a great point you just made, that it's important when the consensio or these moving averages stop going down and the price goes sideways long enough to get all of the moving averages bunched together, and you get higher lows than previous lows, and then you get that breakout. I'll bet you're going to find something interesting there. We're going to move.
I'm looking for it now.
Okay. Yeah.
Nope, I'm in the futures market. That doesn't work. I need to be in the indice market.
Okay.
PSI.
PSI is what I've got. Yeah.
Yep. PSI index. Got it.
Okay. We'll get back to that. I've just got two more charts. This is Mexico. Doesn't look like any of the charts we've just seen for many, many reasons. A big part of it is NAFTA and building the wall and the current presidency. But this is the period of the new president. Look what had been happening all along for the previous period of time. Again, there are regional questions having to do with South America, Latin America, and Mexico, having to do with scandals, elections, Brazil breaking down, Argentina running into some tremendous problems, and that's spreading throughout the region. Again, that's both opportunity and it is risk. And I've never seen this kind of divergence on a worldwide basis. The last one I'm going to show you is Korea. Korea is a powerhouse in trade, in export, in economic activity, keeps motoring its way up the chart of the largest economies in the world. And you can see this tremendous run that it took from 2015, 16 on this scale from 45 up to 80 in a matter of just 2 years. But look what's happening now. Again, the beginning of 2018, where we're seeing all of this consolidation in markets around the world, a period in which we go sideways, testing, a period in which a clear bull market goes sideways. And here, like other Asian countries, we're seeing it roll over and accelerate to the downside, with the long-term moving average moving down and clearly in bear market activity. So we've looked at Japan, Korea, Malaysia, China, Hong Kong. Australia is actually looking like the US market. I was showing some of our Australian clients that chart this morning. I don't have it with me right here, but we are hitting new highs in Australia, and that's important when talking about trade with China. So back to my thesis, you are on the verge of being able to capitalize on some of the biggest moves around the world that I have seen since I started 40 years ago, and studying the history of markets. I have never seen these kind of forces in play before, even going all the way back into the World War II, World War I, late 1900 period, because we didn't have the globalization like we do today. And with all of that, I'm going to go back and to turn it over to Leah and see if Tone was able to find that chart of Portugal.
I did. I don't know, Leah. You want to jump in, or should I just show the Portugal chart real quick?
Let's see it.
All right, let me do screen share. So the cool thing is that on the all-time high in Portugal back in 2014, I don't know if that was the all-time high. It's amazing how there is a 9 literally at the top.
Fabulous.
And there's even a 9 at the prior top.
Wow. That's
now,
great.
At the lows, on the way down, there was also a 9 at the low. That's the ultimate low in the bear market. That must have been a 7 candle. Then the unperfected 9 showed up 2 days later. But after that, I mean, it's good. Like, here's a way up. 9 slows it down. Here's a way up. The 9 ends it. It turned into a 1 by the time the candle ended. And right now, we're looking good. I mean, I would also be thinking bullish on Portugal right now. Just need a green candle above a prior green candle.
Terrific. Thank you very much. People, technical analysis works. It's very powerful. And this is the time to be listening, learning, and watching, because the next 5 years are going to be some of the best opportunities you've ever seen in the financial markets. You need technicals to be able to understand how this all fits together. And now, with that, before we go into Bitcoin, Leah.
That's what I was going to say. Let's hear some Bitcoin talk before we end.
Okay, very, very good. I'm going to just pull up my charts here, which will allow us to quickly go through my iterations of the weekly charts. And we will do that by going right here. There it is. There's a hyperwave. It's in Bitcoin. It caught the entire movement up, has kept us out all the way down. A lot of people are saying we're missing the bottom. Hyperwave says we have not seen the bottom. And we are, as of today, at 82.40 after running up to 83, over 8,300 on this last candle, or very close to it. I want to just throw my indicators on weekly very quickly, because we've got some important changes because of these last 2 weekly candles. So let's start by taking a look at the stop and reverse points. We've got 2 positives in the last 2 weeks, and to get back down into a negative territory, we've got to get all the way down to 5,800, which I believe we are going to do. But until we do, the stop and reverse has now turned positive on a weekly basis. So that's 1. The Bollinger Bands have just turned positive after being negative all the way since, in the way I look at it, since the end of February. Bollinger is now predicting a price move up to around 9,600, which would be that top band. However, we are still early in this candle, and this candle needs to close above the midline on Sunday coming up. I am going to say that I doubt that it is going to do that, but I can't argue with what I'm looking at. We have now broken through decisively what I said was important to me from a Bollinger point of view. I'm going to give this a positive. That's 2 positives. I'm going to now look at Consensio, the moving averages, and we've got the long-term moving down quickly. Tone is saying he believes the death cross in 2 to 3 weeks. I agree with that. The intermediate term has now moved up, is rolled over and slowly moved up. And the short term, of course, is moving up very sharply. I would give this a neutral because I don't believe we're going to be able to break above the long-term moving average, but it is possible that we can get up above it on a penetration of 8,800. At 8,800, we will stick our nose above that long-term moving average. But anyone that knows how you play a long-term moving average that is moving up when price is coming down, such as we saw in the US stock markets, that long-term moving average is going to be formidable support. In this case, the long-term moving average is going to be formidable resistance, and I would fully expect it to turn back any assault on it and give us time for the death cross to take place, in which case I believe the price of Bitcoin will be much, much lower. I'm going to take off the moving average and take a look at the RSI. The RSI is moving up sharply, is now above 50, and I consider it negative because we are now closer to being overbought than oversold, and I don't believe we get to overbought until we get to oversold, and now we've got to fall 21 points just to get down to that level. That's going to take a drop well below 5,000 to get there. So even though most people that use RSI will disagree with me, I believe that this is a negative indicator, not positive. This is the MACD on the bottom. The MACD is still negative, even with all this positive activity of the last 5 weeks. Now, it's barely negative, as you can see by the little line on the histogram, but depending on how we close this Sunday, we could very easily begin to accelerate down. The Bollinger Band could become negative, but I'm using coulds and shoulds and mights as opposed to what I've said up till today. I am impressed with this bounce in the market, and it has turned some of my indicators positive. It has not turned me positive because of what I know about hyperwaves. And I want to just look at one other chart, then I'm going to turn this over to Tone. This is phase 2 of the hyperwave, and it's coming in at 5,180 right now. And that's where I believe we are headed in terms of a test of this line, which will either hold or not hold. And if it does not hold, I believe we're going to 1,000. If it holds, we will have multiple tests over the coming months before we are ready, in my opinion, to proceed up into the higher hyperwave well above the old highs. And with that, I'm going to turn it over to Tone.
All right, DJ Tone.
All right. I don't know if I need to pull up my charts other than I do want to show you one interesting thing, Tyler, that
Great.
Someone pointed out. So in general, I have pretty much been saying over the last like 1 or 2 videos, like you have to go short-term bullish here, but medium-term, I'm still bearish. I still think that at some point before 10,000, we are going to get rejected and we should go back to new lows. I will continue to think that way for a while. Now, the chart that I'm going to pull up is the stop and reverse points that I recently made on the stop and reverse points that I recently made on TradingView. I don't understand this like weird, spike into the red. It could be like a data bug or something. But so we now have a second week. So Tyler is right. There are certain aspects of trading where you don't have to wait for the close of a candle. The sequential system is one of them. In the sequential system, you enter and you change your mind on your views of the market, and you enter trades based on intra-candle moves. With things like Bollinger Bands and moving averages, you have to wait for the candle to close. And when that candle is a weekly candle and it breaks out on a Tuesday, yes, you have a problem, because you don't want it to repeat the percentage move of Monday and Tuesday for 5 more days before you make a decision. And at the same time, there is more than enough time for this candle not only to close red, but close below the prior lows. So there are, you have to understand in which type of trading you're doing, whether you require the candle to close or you don't. Okay. Now, here's the really interesting part. Remember how we compared the SAR? And I said, hey, in the bear market of 2014, we broke the SAR, and that was pretty much the high on the second candle after the SAR break. And then all we did was trend down, and it took like 3 months for us to break the SAR in the other direction, and then we continued going down for like 6 more months. The interesting thing, and as someone pointed out, is that this is not what it looked like on Bitstamp. This is what it looked like on Bitfinex. On Bitstamp, all of these SAR points on the bottom never took place. And let me pull up the Bitstamp version of Bitcoin. So keep an eye on that 2014 bear market, where throughout 2014, we were below the SAR until May. We were above the SAR until September. And then as of September, we were below the SAR for the rest of the year. So if I go to cryptocurrency and I do BTC USD on Bitstamp, and all my annotations came back, and I dropped the annotations. Yeah, once again, it's a problem with, I'll turn off the Bollinger Bands. They're not really critical right now. As you can see, on Bitstamp in 2014, the entire year 2014, from January 1st all the way into 2015, stayed below the SAR.
Wow.
And this is a very, very, I don't even know what, word to use to describe it, but the difference between the two is like amazing.
I guess it was because of that long wick on the green candle at the top that caused that SAR to be so high there?
I don't know. I'm going to go in a different direction. I'm going to take a different wild guess. And I would say that BTC USD Bitstamp, not Bitfinex. I'm going to say, okay, what's going on here? Oh, come on. I'm going to say maybe it's because of this wick. That's clearly a data error that they never corrected.
Yeah, that's what it is. Yeah, you're right.
So it could be because of this dip, and then it caused all of the rest of the SAR points to be lower than they otherwise would. I don't know exactly how SAR works, but that's my only explanation, because the biggest difference between the two charts is this. I was trading the markets. I mean, even if Bitfinex did have a $100 trade, that trade was for a fraction of a Bitcoin. It was totally irrelevant. and I believe this is a data error. Like if I had, the ability to change data in TradingView, I would literally make this dip on this week, the week of February 10th. I would make this dip, relative to what it was on Bitstamp. So that could be what did it.
Yeah, that's great. That's a great perspective. Terrific. Well, we've gone on a lot longer than I thought, but I'm glad we did all of it. I want to turn it over to Leah just to see, are there any questions that pop out to you?
Yeah, I'm gonna always go a little closer for you guys. As qualified retirement accounts cannot take short positions, do you use inverse ETFs? And if so, then how can you target individual stocks breaking phase line 4 that you want to short?
Yeah, very difficult in retirement accounts. You can use inverse in some of them, inverse ETFs, not, you can't short stocks. So what you need to do is you find what the stock category is, such as technology, what industry it's in, such as chip makers, and then you can buy an inverse ETF in that industry. That will not be a perfect hedge against a stock. The best thing to do if a stock is breaking, for example, into a phase 5 hyperwave, is get out of it, because you can't use options in most ERISA accounts and you can't short. So the only thing available to you is this general thing, which is either an inverse mutual fund against an index, or an inverse ETF against an industry group or an index. And that is not a perfect fit. So the best thing, remember, you're not paying taxes. So selling and getting out of a position in a retirement account does not make you liable for long or short-term gains for that year and maybe for 20 or 30 years afterwards. So don't be afraid simply to step aside. In a trading account that is not protected under IRS rules, where by getting out of a position, you could have very large capital gains. The first thing you want to do, and we'll talk about this in a vlog again when we talk about shorting, is the first thing you want to do is you want to match up losses with gains. If you've got a diversified portfolio, you're going to have both. So you can take gains in something that is beginning to deteriorate. Go ahead and do that, and on the same day or very near the same day, go ahead and take a loss approximately equal to the gain you're taking, and then you won't have a taxable, a very significant taxable event, because you can match your gains and your losses, but you must match your shorts against shorts and longs against longs, and you can only take so many short-term losses and have to carry the rest forward. So that's number one. Number two is, if you're going to take a very big gain and people don't like to do it, having to pay a tax on it, then what you can do is you can use inverse funds, or you can short against the box. And we will explain what that means, where you don't actually get out of your position, but you short the same stock that you own. Instead of selling that, you short it against the box, and that hedges you against future price movement. And therefore, you're in control of your taxes once again. So it depends on if it's a retirement account or if it's not a retirement account, but there are ways to handle it in either case.
Thanks, Ty. Okay, one last question because my computer is telling us that we should probably stop with my battery life. Tone, question for you. Would you consider the bottom being in? I'll say it slow. Especially because it's loud. Would you consider the bottom being in if the month closes with a bullish engulfing candle and a breakout through the top of the monthly trading candle? This has signaled the end of the last 3 bear markets? Question mark.
If it's also above 10,000, and then I probably would.
Oh, I had it still on. Tyler, you want to just respond, and then maybe we'll finish off.
Yeah, to me, bullish engulfing candles are very important. But more important in this situation with Bitcoin is the range between 10,000 or 10,100 and 11,875. Let's call it 12,000. That's the important part. All the others are secondary to that. If we can close above that, I will say that the phase 2 line at 5,100 held with the drop down to 57.85. We never even came close to it within 600 or 700 points, but it will establish for me that phase 2 is alive and well, and we have moved into the next stage up of a hyperwave, which will then go all the way up and take out the old highs and keep on going. But that is all dependent on us working our way through that range from 10,000 to 12,000.
Awesome. All right. I think we're going to end it here. I'm getting reverb, but that's not surprising in here, especially with all the Dylan music. Very soon, the morning brief. That'll be good fun. Tyler, thank you so much. This is always fun with my partner. Tone, thank you for joining us.
Great. Thank you.
we got a thumbs up. Do it again. Tone, thumbs up. All right, everybody, thank you so much.
Okay, thank you, Tone. Thanks, Leah.